Good morning, good afternoon, or good evening, depending where you are on the planet. Welcome to the Thursday, the 2nd of May, Bull versus Bear webinar. Steve Miley here on the call for TradeDay.com. Welcome, everyone. We're going to go for our usual regular run through in here today. We're going to take a look at the calendar, both the macroeconomic fundamental calendar, macroeconomic data calendar, but also then the earnings calendar. We'll take a look also at articles from the major news wires. What are the fundamental macroeconomic central bank geopolitical events that are shaping financial markets right here, right now? And then we'll take a look at some charts, the markets that you guys tend to trade. What's the key trigger points as we go into today in the major markets you guys are trading? Let's start off with the calendar. Yesterday it was obviously all about the Fed. We did get the ISM just for due diligence. ADP non-farm employment was slightly better than expected in here, and then the ISM data in here from S&P Global. First of all, the PMI data from S&P Global slightly better than expected, very, very narrowly better than expected. The more important though, ISM data in here, manufacturing data slightly worse, but very marginal, slightly worse. But obviously, all focus was on the Fed, and the Fed was really the driving force yesterday. If we look into today, the calendar on the macro side, relatively light now going into the balance of the day. We did get the European PMI data playing catch up this morning. Okay, Europe was on holiday, as we stated yesterday, much of mainland Europe. So France, Germany on holiday for the Labor Day holiday, the 1st of May Day holiday. So they're playing catch up in here on the PMI data. And you can see in here a sea of green for France, Germany, and the Eurozone as a whole, beating expectations on their manufacturing PMI. European exchange is slightly up this morning in here as well. On the data side going into this afternoon, they've got some trade data and initial jobless claims, which rarely move markets in here. Very, very, very unlikely that's going to have any significant impact on markets. That's coming out in just under 1 hour. A little bit later on, again, this is not really big headline data. We do get factory orders data in here. And going into, we've not got any Fed speakers in here, but going into tomorrow now, we've got the Fed meeting out the way. I'm expecting the Fed speakers to come thick and fast. Looking at the earnings report in here, if we go back, oops, that's wrong. Just clicked on, that's wrong, hold on. Let's go back to yesterday. It was fairly light on the calendar on yesterday. We already had most of these out before we opened. But if we go into today, the critical one is going to be after the bell tonight, Apple. So we get Apple number 6 of the Magnificent 7, and then we don't get anything till NVIDIA until the latter part of this month in about 3 weeks time. I think it's 20 something of May. So in about 3 weeks time. So Apple in here, we do get after the bell though, not till after the bell this evening. So data front are fairly light need to go today, but we're going to look at the aftermath of what we saw on the earnings on the Fed meeting yesterday. So Apple to report after the bell amid sluggish China strategy. So focus on that. You know how sales are going on China. Let's take a look at 5 things to start your day. So Fed fallout. Markets initially leapt higher because there was a real fear that Jerome Powell in the statement and Q&A would be more hawkish than the market was kind of expecting. He wasn't, basically said, we're not going to get rate hikes for a start. He kept rate cuts on the table for this year. Markets were obviously down when we were on the call this time yesterday. We were already down over 0.5%, as I remember, as we went into the opens. And then through the day, I think we dipped even a little bit lower. And then we rallied after the numbers, but then we saw a sell-off into the close. And now we've had a rebound on the overnights in here. So kind of a really bit of a chop fest. Market's not quite sure what to make of it. From a technical perspective, it still looks bullish to me. Going into today on the stock index side, I think really important now. I mean, super important. I stressed this a lot on the webinars at times, that the bond market is going to be critical now if you're trading stocks. I would 100% have an eye. I'd have the bond market levels, and I'm going to come to those in a while. But the bond market levels in here flagged on your charts. Get alerts set on the bond markets, because the bond markets break some key upside levels in price, that's pushing to lower yields today, and they're setting up that way, it could then certainly trigger some upside for the stock indices. Okay, so that's going to be important. We'll run through a little bit of a few of the articles, but basically Overall in here, we've had the fallout from the Fed was, a bit of a chop fest. Markets generally, the bond market is saying to us actually quite likes what Powell is delivering. If we go and we're going to take a look at the CME Fed Watch tool. The Fed Watch tool now starting to price in potential for 2 rate cuts. Remember, at one point we were 6 rate cuts at the beginning of the year. We then went in line with the Fed, and the Fed at the dot plot chart, last dot plot chart told us 3, and we were in line with the Fed. Now the market was pricing almost down to only 1 rate cut this year, and now it's starting to price in potential for 2 rate cuts this year. And then the bond markets is liking that. We've already spoken about Apple in focus today. Back in the US, a number of e-commerce firms look set for a rough day after disappointing earnings yesterday from DoorDash, okay, but not really impacting the broader indices. And in Europe, Novo Nordisk earnings took center stage this morning, so sliding as it says it's a weight loss drug in here, but the numbers fell short of analyst estimates. But again, in here, this is not having a massive impact on us. And another busy day in the forex markets for the yen. A surge briefly in late New York trading in here, and again, it's suspected that intervention from the Japanese authorities as again to protect and to stop the weakness in the yen. Okay, but again, that's not really impacting you guys in here. So just to run through some of the headlines from the major news wires regarding the Fed. Jerome Powell offered markets a reprieve. It vanished in a blink. So that's the fact, he basically sort of said, yes, we could be cutting rates in here. We're not going to be hiking rates. We got the rebound in here, and then the rally vanished as higher for longer reality dawned. So yes, rates could stay higher for longer. Powell keeps rate cuts on table, leaving timing less certain, so we still don't know when they're coming. US stock futures gain as rates release. So this is on the overnight, meaning gaining overnight. And European stocks in here relatively subdued. Remember, we were out yesterday in Europe, for mainland Europe anyway, and downplayed prospects. Next move will be a hike. So kind of taking a hike off the table. So there's a relief at least on that. S&P 500 and NASDAQ in lower after the Fed rate decision yesterday, but then we have rebounded, as I said, overnight. Jerome Powell offer markets a reprieve. Oh, no, we've already had that one. That's duplicated that article. And what else? We've got Fed Powell says looming US election as well. Mentioned the election will not sway the rate decision. So the fact that we're running into rate decisions, and the chances are, if you look at the CME Fed Watch tool, the rate cuts could come going into and around the election. Okay, so that's they obviously try to stay out of the election very much. The Fed, however, they have to do what's right for them, and so they can't just be dictated to by the fact that we have an election. And then overnight, again, the futures climb as Fed allays rate hike worries. Let's take a look at that CME Fed Watch tool. So I just was running through this earlier. Let's just go through all the months now through to the end of the year. If we look at June now, like pretty much no chance, right? This is saying unchanged, only 9% chance we get but really no chance we're going to get a rate cut in the summer at all. And here's July, 70% chance we're unchanged by July as well. But still some hope that we might even get a rate cut for July. I don't think that's going to happen myself. Now we go to September though, and you'll see only a 43% chance that we're unchanged in September. So we've now got over so 56+% chance in here. These add up to 56 plus that we get at least 1 rate cut come September. If we go to November, it's a little bit better, but still looking at the chances are we're only going to get 1 rate cut by November. Now only a 31% chance, just over 31% chance that the rates are unchanged come September. And if you go there by the end of the year, very little chance that we're unchanged by the end of the year. But now it's kind of even between either one, not quite even, but it's not far off. So we've got 39% here. If we add these up, this is actually higher than 39%. So it is more, there's more chance now of 2 rate cuts being priced in. This here adds up to more than 39%. So you've got 17% basically unchanged, 39%, around 39% that we've got 1 rate cut, but then whatever the balance is here and there is obviously 39, 49, 56. So 44% chance we get 2 rate cuts by the end of the year. Okay, so that's interesting that the market's now pricing in potential for 2 rate cuts. That's more than we were kind of anticipating only 24 hours ago. If we go and take a look at what we got in the overnights in here, Nikkei's a little change in here, but we did get this decent jump back higher in the Hang Seng. If we go and take a look at the Eurozone in here, DAX, little change. The German DAX, the FTSE's up 0.3, but the French CAC down 0.8 this morning, playing catch up, remember, having been closed yesterday. And if you go and look at the overnight and the futures, though, it wasn't a big loss. There weren't big losses yesterday. About 3 to 4 tenths down on the Nasdaq and the S&P, having had that choppy session. Remember, opening up down, rallying to being positive on the day, and then ending up just only slightly down. But we've made up all these losses that we posted yesterday already this morning. So we're up nearly 1% on the Nasdaq. As the market is digesting the news from the Fed, and nearly 7/10 here on the S&P. Now, this is where I think what's going to be critical. If we go and take a look at my reports on here, that you can download just below where you are in here, the 30-year in here. You can see in here the big levels all the way up here at 116.5, but there is an interim level in here, and that's we've got 116.5, 116.11. That's going to be the critical levels on the upside. We've already kind of surpassed this little level in here that we had, and I'll come and look at that shortly in here. And so I think the 30-year is potentially closer to making this statement than the 10-year. They could be making them around the same time. The big level on the 10-year in here, 108.20, 2.5 to 25.5 are the levels, these two spikes in here. And if we go and take a look at those on the charts, I've already got them up in here. So this is like, so the 10 years a bit more like the benchmark. So, but these two peaks in here, 108, there we are, 108, 22.5, 108, 25.5. And you can see we're already pushing up now. We've got a little interim level in here, that little high there. 108.08 up through 108.08 we could quickly open up the door to these two peaks in here, 22.5 and 25.5. And if we can get anywhere near that, that's going to start signaling a basing bottoming pattern here on the 10-year, and similar story on the bond, the treasury bond. So that's the 10-year note we looked at. Here's the treasury bond. You can see in here we got right up and just nudged above this little peak in here yesterday, 115.05, and then yesterday we were 115.06. Back above 115.0506, then opens up these two peaks in here, these important two peaks. These are up at 116.05 and then 116.14. 116.05, that spike. If we get anywhere, if we can take out initially these basically yesterday's high here on the 10-year, it puts this peak up in focus, and then that creates real risk of a bottoming pattern. If we get a bottoming price, remember, bottoming price on bonds equals a top in yields. Now I go back to the yield chart in here. Look, we went down yesterday close to this little level here. So this level here is at 457 in yield. Yesterday we got down to 458. So if we can take out 457 in yield, then it opens up these two low yields in here. So we've got pretty much at like 450 and then 448. And if we can get down through any, or even approaching 450 in yield in 10-year, okay, that's going to be super important for then a yield top. It will point to lower yields, and remember, lower yields are positive for stocks, and then it would open up the upside. Going back to my stock index charts in here, really open up the upside. So even though we had that sell off yesterday, we've already rebounded. And the S&P, look, we're just, clinging to opportunistic longs. We're still staying cautiously bullish here on the Nasdaq. But remember, now we're up significantly from the levels. This was written last night, so it's looking even better in here now. And I do think, this is continuing to build to this being more of a basing pattern. We obviously had that notable sell-off in here a couple of days ago. Back on, what was it, Tuesday? We had the sell-off. Yeah, Tuesday we had the sell-off. But already this looks like a succession of higher highs and higher lows in here. This is on the ES, on the S&P. I can easily see us back up to yesterday's peak, and maybe even up to the peak in here over the next 2 days. Remember, the only kind of fly in the ointment at the moment, the only thing the spanner in the works from us going significantly higher is we've got the looming US employment report tomorrow, and ahead of there we've got Apple tonight. But I do think there's real risk that could be an inside day today, but an inside day could easily take us back up to yesterday's peak, which in here is 51.2675. We zoom in onto the 30-minute in here. So there's that spike post-Fed, and then we obviously gave a lot of it back, but now we're gaining all back in here already. And I think the critical level, if you want an interim level in here, is I'm going to be looking for 50% of yesterday's range. So there's yesterday's range. The half, we're already through the 50%. Okay, so 61.8% now. That's around 50.93. If we can take out 50.93, I think we could easily be back up towards the highs. Easily back up towards 51.10.15 area. So 50.93 on the ES. Similar story on all of that for the Nasdaq in here. Sell off yesterday, rebounding yesterday, selling off again, rebounding again in here this morning. But this looks part of a bigger basing pattern. And if we go into the Nasdaq in here, there's yesterday's range. Going to do the same in here. Put the Fibonacci retracement on for yesterday's range. And where does it leave us? in here where we're flirting with the 50% already in here. That's not the 38.2, that's actually the 61.8. That comes around 17, 640, 45. I think that's going to be the critical area in here. If we can get up through those two levels in here, I think on the SP and NASDAQ, we're potentially pushing back up to the highs. But I think really critically, it might not happen today, it might not do it ahead of payrolls, but looking at these levels on yield, probably more easier to watch in here, these levels on the bond markets. Looking for these bonds. If you see the bonds start pushing up through resistance levels in here, we can easily see these stocks tear back to the upside and go up back to the peaks that we saw yesterday, those spike peaks that we saw yesterday after the Fed announcement. Okay. All right, guys, I'm going to leave it there. I'm going to wrap it up. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you for another Bull versus Bear webinar tomorrow. Don't forget, we've got Apple after the bell. Bye.